So thank you so much for joining in today. Obviously, we're looking at starting the first unit for some of you who are looking at working towards this IFA, certification process. We're looking at starting the unit, which is Law for Accounting, one of the mandatory units that you have to cover. And in the context of, the study of this particular unit, what we will be looking at is to understand the legal side of things in terms of, laws, acts, legislation, which sometimes we have to follow, be aware of, or at least be guided by when we're actually providing some of the accounting, bookkeeping, and related services to some of our clients, or, obviously working within this field in general within financial services or, the accounting profession. Now, the unit is actually focused on giving us a bit of a perspective on understanding what the English legal system is. And when we look at, obviously, the English legal system and the law, which has been, the laws which have been made over the years, they pretty much also have been implemented in about 61 Commonwealth countries, which obviously have very close association with UK. Now, in terms of looking at, a couple of things with regards to this unit, what we are going to be focused on is understanding how and which part of the law side of things relate to accounting side of things at our end. So things like when we talk about, one of the things which we have learned and seen happening in the last few years is data protection. So Data Protection Act of 1998 has been revised in 2008, and we've also seen a revision of that happening with the General Data Protection Regulation, or GDPR as we call them, when it was introduced under the EU side of things in 2015, and most companies, businesses, organizations had about 2 years to be able to implement this. And how does this have ramifications towards when we look at, handling data, particularly in the accounting profession? So sometimes we use a term called KYC, Know Your Client. And obviously, when we have the KYC documentation for which we maintain a file, because if you're dealing on behalf of the client with HMRC, sometimes you have to have permissions and authorizations in place to be able to access the accounts and access some of the, related documentation. And in those cases, what we do is, we will be looking at understanding why we require KYC. So some part of it is under the remit of law, and that is what we're going to understand in this particular unit. Now, the unit is graded. So obviously at some stage when you finish this unit, reading into it, you will be looking at attempting an assignment, and that assignment is going to be graded. So it's going to be pass, merit, and distinction. This unit carries 15 credits. So it's an academic unit. You're in an academic qualification. So obviously this particular course that you're doing, at some stage when you cover a number of units with us, at some stage you'll have a number of credits, and obviously they can be reflected as academic credits in your CV, in your overall qualification that you write. So this unit is equivalent to 15 credits. Now the unit is divided into 4 learning outcomes. So learning outcomes, or in short LOs as we write them. So they will be looking at different aspects of the English legal system and how this law actually impacts on some of the professional accounting services that we provide on a day in, day out basis. So we are going to have 4 sessions covering 4 of these learning outcomes, and this will be followed by a 5th or a last session in which we are going to discuss, or basically, cover the assignment brief to discuss it in a bit of detail to understand how the evidence for the unit has to be created, so that when you submit your assignment, you know exactly what grade you're going to get, and obviously, how you're going to go about, collating the evidence. Now, I just can't teach you anything in this unit for the sake that I'm a teacher and a lecturer, but, from my point of view, we get some boundaries or remits in terms of what we need to teach, and how can you say and be confident that I have read this unit, I have studied this unit, and I have enough knowledge now so that I can apply the legal terminology, legal terms and conditions related to the field of accountancy, accountancy practice, or as a profession from a point of view of law. So towards this sheet that I'm looking at, which you see on your screen right now, this particular sheet that we talk about, is basically called the Unit Specification, or US. And this Unit Specification sheet actually informs us what is to be taught in the unit. So we look at the indicative content, and some of the indicative content is structured into individual learning outcomes. So when we talk about understand the elements of law affecting commercial practice, this is what we're going to be studying today as the first learning outcome. And in that, we'll cover elements of contract law, laws of agency, laws of tort, and that itself would then inform us that we have comprehensively covered learning outcome 1 and some of the assessment criteria which are given here. And when we talk about assessment criteria under pass, merit, and distinction, so we have looked at, we would be covering ideas and some of these criteria, which include things like analyze the elements and nature of contractual agreements, what is agency and agency relationship, and so on and so forth. So this particular document is available on Moodle, and this is generally the first document that you see when you access Moodle at your end into the course material. And when you go, you will generally see this unit specification brief being the first document as a guidance document, which is generally provided in the unit when you access it. So if I just quickly switch you over to Moodle, what you will generally see here is this particular document that we see is listed here, which is Unit 8, because it's a part of ATHE curriculum. That's why it says Unit 8, but law for accounting, that's the unit specification brief that I have pulled out, and that is what we are going to be using as a guide from a lecturer's point of view to teach and inform what is to be covered in this unit. So some part of it is a bit repetitive, but because it's the first session, what I want to do is obviously lay down some ground rules so that you know exactly what is being used, what is being pulled from the system, and how the process of delivery will happen. And then we have the assignment brief, some of the books which are recommended by ATHE for covering this unit, and then you have delivery. So obviously deliveries keep changing, but I've just delivered this unit last month, so I'm delivering it again. So obviously new recordings will come on, and there are some handouts under the recordings which are useful for crystallizing some of the concepts that we discussed in today's session, and they will form some additional reading. But obviously the presentation that I'm going to show and cover is basically given here, and we're going to go through some of the presentation slides to discuss the learning outcome 1. So I'm going to unmute Adnan for a second and ask him to mute himself. That would mean that there is no background noise. Is that okay, Adnan? Can you mute your microphone? If you are asking any questions, please feel free to ask me. Go on.
Yeah, exactly. I'm all right, and I have no background voices anyway, so I'm all right.
That's fine. So if you just mute your microphone at your end, just click on mute, and that will mute your microphone.
Yeah, definitely I will. Yeah, no problem. Yeah.
Okay,
so please, if you don't mind, please could you repeat how we can open this on our dashboard, like the accounting thing, the module we are doing now, the law for accounting, from where we can just open it?
Basically, there is an email which we have sent you, Adnan, this afternoon early,
yeah.
And this email that you see is going to ask you to go through this particular induction video. So when you click on this particular image, it will take you through the whole process of how to access the course material, and it has a pretty much short induction built in for about 30 minutes, and it will take you through the full process of how you will go through the course or this particular unit in discussion today, which is law in accounting. So I won't go into specifics of this because this is not an induction session, it's a teaching session. So what I would suggest is if you watch this induction recording, this is there in all the units that you will study with us. So it is a generic recording, but it will take you through the full structure of the unit, how it is delivered, how assignments have to be done, where the feedback and how the assignment have to be submitted, how you get feedback. There are samplers and different documents which are uploaded on Moodle. All are explained in that particular recording.
Yeah, thank you very much. I got this on my screen as well, so I will watch it later. Thank you very much.
That's great. So let's start off with this particular unit, wherein what I've got on the screen now is the first learning outcome that we're going to be covering today. And this first learning outcome focuses on basically understanding the elements of law which can actually affect commercial practice. Now, the indicative content that we're going to cover in this unit is going to be related to some elements of contract law. It is going to relate to the a law of agency, or when you appoint somebody with the power of attorney or somebody who represents you in a contract, then what is the agency, what is the agent, and who is the agent, who is the principal, and what this relationship is called is the agency relationship, and that is what we're going to be looking at in terms of law of agency. And to some extent, we are also going to be looking into, very, very briefly, law of tort is a specific, branch of law, and it's a detailed unit altogether. But briefly, we are going to be looking at the law of tort, and the law of tort basically is, common law, which is basically a combination of common law and civil law. And in most, cases, when we talk about vast majority of legal systems that we see in different countries, you will generally see that the law which is derived by or from court judgments, county court judgments, and the law which basically looks at dealing into say harmful behavior, physical attack or some sort of violence which can actually lead to bodily harm, will basically look at covering that aspect of law. So what we want to be able to do is, sometimes when you get to see that when you go to the bank or when you go to certain public places, you generally see that there is a poster up on the wall which says, please treat and deal with our employees with respect. So, or our staff with respect. Now, if you generally see that if you raise your voice or if you act towards any particular employee or a staff in that location, what tends to happen is that the staff has their right or within the remit to be able to call the authority or report or ask for assistance, because in this case they feel that you are basically looking at either causing harm or you are looking at some sort of a harmful behavior, and that would basically mean that in those cases we will look at understanding what is the law of tort. So very, very briefly we will look at this particular side of the law, which basically informs us on some of the key elements of how this can be invoked and in what situations and places this can actually become important for us when we are dealing with businesses, organizations, or individuals, or representing them by providing them some services. So in the case of accountancy, if I just give you a broad example, if I have to say what is law of tort, for example, you've got into a car, and you've had an accident. So what happens is, in the accident, you were not willingly looking at causing harm, but because of negligence, this accident has happened because you had maybe, you looked at your phone for a minute, or you had a lapse of attention while driving, and that has led to the crash with another car. So what this has happened is, in this case, the law of tort would apply, because what we need to be able to look at in terms of the reason is that though your intentions were not there, but somehow because of lapses of concentration or maybe circumstances in that situation, there is a crash which has happened, and that has happened because of your negligence or because of your wrongdoing. And in those circumstances, we would look at the science or the branch of law which deals with such cases would be the law of tort. So things like car accidents, when you look at insurance policies, when you look at contracts not being fulfilled, when you look at negligence happening in remedial, in some cases wherein contracts are not delivered fully, and in some cases when we have to resort to taking the matter to the court, and the court decides who's right and who's wrong, and what penalties or what some sort of liabilities have to be covered or compensations have to be given. They are all covered under the law of tort. So we will look at some part of it very briefly to cover this in learning outcome 1. Now, broadly speaking, when we talk about law, there are two types of law: private law and public law. Public law, which is used by the government, by the federal government, state governments. You look at basically some sort of governmental body which uses law to run the day-to-day functions of a country, economy, or a location, whether it's the council in the UK. So when you are living in different areas, you have the councils, the city councils use county courts, but in this case, the councils are representing, or they are working on behalf of the government to be able to provide and deliver services. So if there is something which has to be tried in the court of law, and you bring a case across to the court against the council or against a government body or an official, those cases you would generally see that they are all covered under the remit of what is called public law. So they are related to acts, legislations, or laws which have been created over the years in the Parliament through statutes and acts, and they are normally all covered under what is called public law. Now, public law also covers criminal law, just as an example. Why? Because in this case, if there is destruction of public property, if there is criminal intent in terms of theft, burglary, we look at money laundering, couple of other transaction side of things within the accountancy profession or in the financial services, we look at which can happen. They will also be all covered under what is called public law. But under the public law, the branch of public law which deals with forgery, money laundering, things which basically can lead to harm or some sort of criminal intent will be covered under criminal law. Then the other side of law we talk about broadly is private law or civil law. And in this, again, there are different branches of law wherein you look at contract law, which is what we are going to be focused on in law for accounting unit. There is tort law. Some part of contract and tort law is going to be very directly related to what we are going to study in this particular unit. Then there is property law, there are trusts, and there are family laws. There is immigration law, there is IPO, intellectual property rights, and related to that law. So there are lots of different types, and they are basically, because in this case, if there are disputes which arise, contracts which are not fulfilled, or negligence which happens and leads to liabilities, they are decided in the court of law, and because they are between one business and individual, or individual and individual, or individual versus businesses, they are all covered under what is called the private remit or civil law. Now, going deeper into understanding what is the branch of law that we are going to be dealing with is contract law and law of tort. So when we talk about contract law in general, when we talk about the word contract, when we say there is an agreement being formed and when we say there is a contract that I've done, there is a difference between these two terms. So when we talk about agreement is that there is an offer that you've made and somebody has accepted your offer, there's an agreement. Now that could be verbal or it could be written. But then when that agreement becomes enforceable by law, that means you ink that and both parties sign to it and adhere to or at least agree to adhere to the terms and conditions which have been discussed in the agreement, and then they ink it on paper, then it becomes a contract. So when we talk about agreements and when we talk about contracts, it's slightly different. So when we talk about contracts, you go in for an interview for a job, you have been shortlisted by the agency, you have been invited to attend an interview, there is an agreement between you and the agency, the recruiter, to put you in front of the employer or the organization which is going to interview you, and on being successful, you would be issued an employment contract. So the agreement happens between you and the recruiter, and the contract happens when you actually land the job. So subtle differences between the two terms that we need to acknowledge, so that when we use them within this particular unit, if you have a client and you provide those, say for example, accountancy services to the client, then at the end of the year you've agreed, or at the start of the let's say the agreement, or at the start of the financial year, you've agreed to signing a contract that if I do the accounting services, prepare the accounts, submit it to the HMRC, company's house, look at doing your bookkeeping, there is an X amount of cost, and those are the services that you will charge to your client, and that will become a contract. So the client is liable to pay you for your services that you're providing in terms of bookkeeping, accounting, preparation of statements, submission to the company house, and things like that. So an agreement would be when you're having mutual discussions, say, no, I don't agree to this price, this is going to be the number of invoices, this is going to be the workload, and you discuss, negotiate. This is all happening as a bit of a verbal agreement. But at some stage when both the parties agree, that at that stage you will ink that. It will be documented, both the parties will sign, and there will be terms and conditions in the contract when you are supposed to be paid, or when the services have to be delivered, what are your responsibilities, what are the responsibilities of the client. All that will be covered under contract. There are lots of different types of contracts that we come across on a daily basis, and these contracts could be, you do a tenancy contract or an agreement with, if you're a landlord, you do an employment contract, you take out an insurance policy and that is an agreement or a contract between you and the company which is providing the insurance, and you're paying in return the premiums for that insurance, and all these will constitute what is called contract. Now, the other side of things that you need to look at is when does an agreement differentiate from a contract? Because in the contract, you will include the fine prints, as we call them, or terms and conditions, which define very clearly what if then else happens. That means if this is not fulfilled, then I could charge you interest at the rate of so and so over the Bank of England base rate. Or if this in payment is not made on time and is defaulted, then we can ask for a £50 administration fees. Now, when you start to include these terms and conditions in the agreement, that is where the legal side of things start to build up, and the agreements actually translate into a contract, because you're building in arguments which are going to be helping you or the other party. If there's a default, if there's non-fulfillment of contract or non-fulfillment of some of the terms and conditions, what has been agreed in the agreement, then you would be allowed to take a legal recourse, and that is where that would then become a contract. So there are different elements of contract, and these elements start off with an agreement. We have an intention to exchange or sign and agree for these services. There's a certainty, that means there's a time period involved. There is a capacity. Sometimes you write things like this contract or this agreement is, if it has to be taken to court, it is valid in the court in England and Wales or in Northern Ireland or Scotland and things like that. And when you look at considerations, you're defining the terms and conditions which will allow or help you safeguard what has been agreed in order for either the service to be delivered or services to be rendered. And they will form the vital elements of a contract. Now, this particular slide that you see actually, details out the contract to a certain extent in terms of what the basic elements of how a contract is formed. So there are some two parties which are required to be able to form a contract. Somebody offers, somebody accepts. There is a consideration, that means there is some sort of discussion, negotiation which happens. Then at some stage it leads to a phase wherein there is an intention to create or sign that agreement into some sort of a contract. You discuss the terms. There will be different types of contracts which can be formed. And then in some cases, when you discuss terms, you look at some exclusion clauses. So what do you mean by exclusion clauses? Anybody, any idea? When we say exclusion clauses, so the exclusion clauses would be sometimes if you see people nowadays, if you're living close by to, say, the banks of river or canals, and if your property is liable for flooding, for example, then in some cases, insurance companies would put an exclusion clause in the policy to say that because your property is flood prone, there would be an exclusion clause. That means they would say that the excess payable in case if you make a claim for up to 5,000 is going to be £1,000. If it is up to 10,000, it's going to be £2,500. So what they've done is they put an exclusion clause which might state that no damages would be payable, say in certain circumstances, because they already have established that the property is prone to flooding because you're close to a bank or close to the banks of a river. So in some cases, contracts would also include exclusion clauses. Obviously, they're going to be covered under, the private and what you call the, civil law things. Some of them would need and will need to take into account some of the acts and legislations which are already in place. So when we look at, most of us buy things from Amazon, or when you buy online, there are certain contracts which, resellers have to adhere to. So some of these are part and parcel because they are acts, they've been passed in Parliament. In most circumstances, most companies have to follow these, and some of these have to be incorporated into, the contract which is being made. And that is where you would generally see that some of these acts and other bits are also included as statutory rules in the agreement, and then once they are signed, they become what is called a contract. Now, some of the ones that we need to be aware of, from a general knowledge perspective, you look at some of the basic acts. If you're dealing with clients or clients who are dealing in trading businesses, there is a Trade Descriptions Act, which is TDA, and in this case, basically the act means that the organization business which is selling a product or a service cannot misinform the customers in terms of what are the let's say, cannot misrepresent the product or service that they are selling. And if you feel as a consumer that this has been misrepresented, they've claimed that this is the case, this is the benefits, and this is what you'll get, but we'll get something short of what has been described in terms of the description on the website or on the manual or in the store when you bought it, then you can actually take the concerned party to court, and they are all covered under what is called the TDA, or the Trade Descriptions Act. There are 3 or 4 acts that we need to be aware of, and that is from a trading standards point of view. And these tend to be the Unfair Contract Acts, or UCTA, of 1997, wherein basically the main essence of the contract is that sometimes you would see parties avoid liability by including what are called exclusion clauses or disclaimers. They will write in the fine print, which will say, product as seen in the picture, or the picture of the product is not of the actual product. In some cases, sometimes when you see advertising being done, they highlight a lot of USPs or features of the product or good that you're looking at buying, but sometimes they fall short of what was actually shown and what actually has been delivered. So in some cases, in order to protect the consumer, this particular Unfair Contract Act protects, and avoids, the trader or the company or the organization to do away with their responsibility by looking at putting exclusion clauses. And this is one of the acts which also needs to be looked at from a point that sometimes you see in certain places, businesses, organizations would exclude, say, for example, personal injury or bodily harm which could happen on certain premises. So all employers, for example, need to have public liability or employers insurance for liability, because if people are working within the office, it is the responsibility of the employer to ensure that safe and health and safety restricted related facilities are provided, which provide a safe working environment. Now, in some cases, you would see that Unfair Contract Act would apply, that if there is no public liability insurance or employers liability insurance and employees are working, and if something is to happen as an incident, and in this case the employer says, no, I'm not responsible for looking into the compensation or the harm which has been caused, reimbursement of expenses, then in those cases you would generally see the Unfair Contract Act being applied. Normally it is done in the cases of, when we are looking at goods and services, but just as an example explained how that would mean that, sometimes these conditions have to be met from an employer's perspective. We also look at the Unfair Terms in Consumer Contract Regulation of 1999. This is obviously, the UTCC regulation that we normally get to see when you're buying products online or you're buying products in store, or when you're providing services. Sometimes you have to, adhere to some of these contractual regulations, which basically cover, certain things related to protecting the consumer's legal right. So in this case, sometimes when you buy a product, you are under the obligation that you can return some of these products within 14 days or 28 days under the Consumer Rights Act. But in certain cases, organizations can refuse to accept a return or a reversal in terms of the product and services, because in certain cases you would generally see that they would not apply because of personal hygiene. So sometimes you would see that these unfair contract terms can they've been put in place, and acts which have been put in place to safeguard both the consumer rights and also in some cases, rights for organizations and businesses which are primarily dealing and providing goods and services to the members of public through various routes, online distribution, retailing, whatever that case may be. So when we look at in general contract law, we are looking at getting a broader understanding in terms of how contracts are formed, when contracts are valid, and then in what cases when these contracts are valid, we need to be aware of some of the acts which are important from a point of view of ensuring that we are adhering to understanding of the contract, and some of the acts and legislation that we need to be aware of. They are basically important for us to understand. Any questions on this so far? Okay. Now, let's look at getting into some of the assessment criteria with some basic understanding and key terminology. Let's look at some of the assessment criteria. Now, the first one talks about analyze the elements and nature of contractual agreements. So here, what we are looking at doing is basically discussing what are the elements of contract. The 7 elements that we have briefly discussed are the ones that we need to cover in this case. So how a contract is generally formed. And when we talk about the elements and nature of contractual agreements, what we need to be able to do is basically discuss when an agreement is formed. The agreement is formed between 2 parties. The agreement generally agrees, or the 2 parties generally have some sort of a consensus on providing services or accepting services. In some cases, we will look at consideration. We will also look at that this consideration is primarily, covered under a certain capacity. That means if the services are not provided, for example, if somebody decides to say that we'll be looking at signing a contract, but the company goes into administration, then what part of the liability can be covered under that particular context? If the company is to go into administration, that will be covered under capacity. Legality would be looking at things which basically include, in which court, essentially, if the matters have to be taken to court, where and how those proceedings would be decided would be covered under, the legality side of things. So when we talk about a contract is formed when 2 parties or individuals agree to creating a legally binding agreement, and that agreement will have certain elements which will basically meet the requirements of that agreement being termed as a contract. So in some cases, when you look at privity of contract, which would essentially mean that there's a relationship which is being formed between the 2 parties, and each party or the entity is basically going to be able to, retort to legal action if the contractual obligations are not fulfilled. We look at construction, we look at mitigating factors, we look at discharge of obligations, and in some cases, we also talk about remedies. So when we talk about remedies, what we basically mean, in terms of remedies is that we basically look at talking about if there is a breach of contract, if the contract is not fulfilled, then in those cases, remedies would mean that what are the options the client or the plaintiff or the defendant, in this case, both the parties can actually claim if they take this matter to the court. So in some cases, you would normally see remedies could be covering up of liability in terms of money. It could be compensation which is provided. In some cases, it could be losses which are covered. For example, if somebody was dealing in perishable goods, and if the goods were not stored properly, but under the agreement, the warehouse was supposed to provide conditions where the goods were supposed to be protected, and if they perished, then in that case, if a contract is broken and they take it to court, the court might decide that, okay, the loss of the inventory has to be covered by the business, which is the warehouse, because they were responsible for providing premises which would, protect for example, the property or the goods which were stored in that warehouse. So in some cases, restriction orders can be done because they are causing inconvenience. It could be related to speculative damages. It could be related to, any sort of a damage which the client might suffer, and they would all be classed under what are called remedies. Now, there's a small video which explains this in about 2.5 minutes. This is something which I would suggest that if you watch, will basically explain with 1 or 2 examples in terms of what is a contract, how it is formed, and why this is important. So let's briefly look into this particular video just for the sake of covering this context, and hopefully that should give you a bit of clarity in terms of what we've discussed so far. So let me just share this particular window, and let's play this
discuss what we
contract.
mean by a contract. When you think about contract law, first, think about promises. But these are promises recognized as legal obligations by a court. And if this legally recognized promise is broken, a court might impose liability on the party breaking the promise. Now, people make promises all the time. For example, I promise to meet you next week. Don't worry, I promise you it won't rain. But with contracts, remember, we're concerned with liability if the person breaks a promise. If your friend doesn't show up in the park as scheduled, we don't expect a court to make someone pay for not showing up on a date. Likewise, maybe your friend promised you that it wouldn't rain, but you're probably not going to sue your friend because her weather prediction was wrong. Without even studying the law, instinctively, we don't expect your friend's weather prediction to be a legally enforceable contract. On the other hand, if we have a promise to sell a scooter in exchange for money, and one party pays money but there's no scooter, well, that seems to be a broken promise, for which we expect there to be some liability. So what's the difference then between a broken promise to be someone's best friend and a broken promise to sell or to buy a scooter? When should a promise be part of a contract, a legally enforceable agreement? We can say that a contract is made of distinct pieces that we'll call elements. And if we have the necessary elements, we have a contract. You can think of elements of a contract the way you might think of ingredients to a soup. If we have the right ingredients, we can make our soup. But now we're asking, what do we need? What are the elements to form a contract? And generally, our three elements for a contract are offer, acceptance, and consideration. Before we can have a contract, we should have these three elements. We'll say the offer and the acceptance are a mutual agreement to enter into a deal. And consideration will mean the parties are giving and getting something. For example, paying money in exchange for a painting. And we'll need all three elements to have a contract. This course focuses primarily on the offer.
So essentially, when we look at the elements of contract, when we talk about contracts, in the commercial sense, because what we want to be able to look at contracts from a point of view of is the contracts that we talk about, which are formed between businesses, individuals, organizations. And in those cases, when we talk about these contracts, what we need to be also including is on that side, some of the elements of contract which are apart from the offer, acceptance, and consideration. We need to be looking at, mitigating factors, and we need to look at remedies and obviously the discharge of obligations. Sometimes we get to hear these terms as what are called the SLAs. So when you have a contract, yes, you've discussed most of the components of the contract, what are going to be included, what services are going to be provided. But when we talk about if these services are not provided, not fulfilled, then we talk about things like service level agreements. If something is to go down or if something is reported, you need to be able to respond in so many hours, so many minutes, so much days. They are all going to be looked at in the discharge of obligations. And then remedies have been added because if we take a legal recourse, take them to court of law, then what are the options in terms of solutions that both the parties can get are going to be covered under a remedy. So in the first task that we are going to look at here, what you have to do is explain the elements, the 7 elements of the contract, and in what case you would say a agreement is formed, and after the agreement is formed, it takes the shape of a contract. And that would help accomplish, the first part of the task, which is to understand what is a contract, what are the aims of signing a contract or creating a contract, and then if the agreement has been done in principle, then how this can be enforced in the court of law. And then you're covering some of the other elements which are basically related to the contract law, and that would help you cover this particular task. Now, towards the end, you could stitch in an example wherein, as it was explained in the video, that you could look at the elements of the contract as a part of the ingredients of a soup. But obviously, from a point of view of academic side and looking at law for accounting, we're going to be looking at covering these 7 elements and obviously say that, okay, these are the contracts. Now, when we talk about contracts, we also talk about different types. There are what are called unilateral contracts. There are also called bilateral contracts or agreements. Sometimes you would see these terms coming across in the news that the government of UK has signed a bilateral trade agreement with so-and-so country. You sometimes also hear that there are unilateral contracts which have been, agreed, or agreements which have been agreed, wherein only one party essentially agrees to, the side of the contract. So when we look at, insurance agreements, for example, they tend to be unilateral agreements, because when the insurance company tends to provide you, let's say, an insurance policy, what is happening is that in those cases, you would generally see that, as long as you adhere to the terms and conditions of what has been agreed before you take out a policy, your agreement stands, or your insurance policy actually stands, valid. But the moment you look at not adhering to those terms and conditions which have been set by the primary party, which is going to provide those services or provide you an insurance cover for those services, then in those cases the contracts become null and void. So when we talk about unilateral contracts, they are primarily one-sided, and they're legally binding agreements where one party agrees to pay or provide certain services for a certain type of fee which is charged, and in those cases you would look at what is called the unilateral agreement. Now these are further expansions into understanding contracts, types of contracts. There are very many different types of contract, but the idea here is, because it talks about analysis, what you have to do is build your arguments. So some of the arguments that I'm trying to build in order to do this task would be to look at providing details about the type of contracts or agreements, and in this case cover unilateral, bilateral, and then some differences or advantages and disadvantages, and that would help us cover this particular task. So in this next slide, I've differentiated, given some differences between what is an agreement and a contract, and in the other part of the slide I've covered what is the difference between a unilateral and a bilateral contract. And these arguments would allow us to explain and cover this particular task, because the command verb in the assessment criteria talks about primarily covering analysis by discussing the elements of contract and how the the elements of the 7 elements actually help us form what are called contractual agreements. Is that okay? Any questions on this so far?
No questions, thank you.
Okay, great. So I've covered this, through a flow chart which nicely defines what we started off initially, and then we'll talk in a bit more detail in terms of how agreements, contract, consideration, 7 elements of it actually come across, and how it forms a contract. Now, in the second learning outcome, we are going to be looking, the second assessment criteria of the first learning outcome, it talks about explain the principles of agency and their impact on business practice. Now, let's understand very briefly what is principles of agency first. So, in the context of principles of agency, let's break it down in terms of understanding, what do we mean by an agency. Now, sometimes you would see that in order to carry out work or carry out certain, tasks and activities, you would generally see that you'll have to look at soliciting somebody's, let's say, let's say you have to take help or support from some of the, people in order to actually deliver those services. So when in such circumstances, what you see tends to happen is that when we talk about, principles, that means if you are the person who's asking somebody to carry out a task, then in that case you would be called or termed as a principal. The person which is actually acting on your behalf is going to be called an agent, because he or she would be representing you in a certain situation or in a certain place, because you're not physically present, could be one such case, or you appointed that person to be able to proxy you to discuss and deal on your behalf when you're dealing with certain types of organizations or businesses. So when we talk about a person or an organization or a business appointing somebody to carry out some services in return for say for example financial or consultancy based fees basis, and the person in this case would be called the agent. The organization, business, or the individual appointing that person is going to be termed as principal. And then the relationship which entails, which allows the whole process to work. So you pass on some instructions, those instructions are carried out by your agent, and then in return that work gets done, or the contract gets fulfilled, or the services get delivered, then that part of the relationship is called the agency. That remit becomes the agency. So when we talk about the principles of agency, what we essentially mean here is that in some cases you would look at, an agent generally carries out, or a person or an agent generally carries out the principal duties of the organization or the business with reasonable care, and certain key deliverables being defined, and this is done in the best interest of the principal by the person representing the principal or the agency or the business, and this whole relationship around which the business or the whole transaction happens is called the agency relationship. So in general, when we talk about, let's say, the principles of agency, or in this case the law of agency, what we basically mean is that it's an area of commercial dealing which can have certain set of commercial, contractual and quasi-contractual transactions which are done on behalf of the main person or the principal, carried out by a third party or a second party which is appointed as an agent, and this party is authorized on behalf of the principal or the individual who seeks the services to carry out such action in order to fulfill those tasks. And when we talk about this whole process through which it works in the court of law, and in obviously from a contractual point of view, these are all documented under the principles of agency. Now, in terms of talking about the principles of agency, what we also need to be able to do is define the three key players and how this agency principal relationship actually works. So agency agent principal actually works. So an agent is employed by the principal to carry out tasks on their behalf. Agency refers to the relationship between the principal and the agent. So in exchange for you carrying out, say for example, financial services, or say for example accountancy services on behalf of your client, you're charging your client some costs, and the process through which this entails is an agency relationship. A simple example of this, I would say, outside this profession would be when you decide to take up services of a marketing agency to market your business. You might decide that, okay, I need to hire an organization which will create a website and do some of the services, or like marketing services, Google AdWords and things like that for the company. So in those cases, what will happen is you as the owner of the business are going to speak to an organization which is going to provide you some services, and these services are related to digital marketing, setting up your website. Now, if you see this, the appointment of the organization to provide these services to you would be the agency. Now, the agency would use staff, third party, contractual labor, supply, people or whatever, because in the agency they might have different types of partners, suppliers, contractors, consultants who would work on these services on behalf of the agency and provide those services to the principal, or in this case the client. This would entail what is called the agency relationship. So this is what is the main principle of agency that we need to understand, that generally the party which is or the agent which owes the principal duties, principal responsibility of carrying out some of these duties as per the direction of the principal and carries them out with reasonable care, in return gets what is called, a fees, and that would basically be the whole relationship of the principle of agency. So in this case, what we generally see is that there is an agreement, and that agreement will be a contract at some stage, because when you appoint somebody to take, let's say, carry out certain responsibilities or tasks on your behalf, you document this, you provide maybe some sort of a job sheet, and once those are done, in return, the agent which is carrying out the job actually receives the fee or the services fee. And how the agent actually gets the work done through liaising with or taking out services of different people, businesses, organizations, and they in return provide you receipts and every record and all those things, would then entail in terms of the specifics of what has been defined in that agreement, that, okay, there are certain costs that are going to be straight away reimbursable, and in some cases, if you're traveling to locations, or if you're wining and dining, entertainment expenses, or any other expenses which are being incurred to, say for example, printing expenses, then those receipts will need to be provided in order to claim those back from the principal. And all this is defined within the the principles of agency. So sometimes you would see that within the contracts, when we look at providing professional services, you would be actively using the principles of agency. And here the idea is to understand and separate the role of the principal, the role of the agent, which is acting on their behalf or on your behalf, and then the services which are being rendered, but being rendered in the best interest of the principal, and that would avoid any conflict of interest, will all be covered under the agency principle. So what we need to be able to do in this task, because it talks about explaining, we need to go into a bit more detail to understand how do we separate the three components under the agency theory, which is principals, agents, and the tasks which the company or the agency is actually managing. And in this case, maybe take up an example by what I've done on the slide is I've taken an example of a company wherein the directors of the company are different from the owners of the company, but the directors and the owners have shareholding. And in this case, the directors are tasked with the prima facie responsibility of driving the activities of the company in such a way that it leads to revenue increase and profitability. Now, the director of the directors who are working within the company are basically acting as agents on behalf of the owners or the major shareholders of the company, and their roles and responsibilities are very clearly defined, that this is what they need to do, this is how they need to transact the business, and this transaction of business or transactions that they carry out should lead to revenue, turnover, increase in profitability for the business, and they are accountable to the shareholders or the owners of the company. Now, when they look at employing for example, various other parties to carry out the roles and responsibilities required in order to generate profit from those activities or increase revenue from those activities, then they are going to be looking at appointing staff, employees, partners, suppliers, and they would essentially be, looking at working through the agency side of setup, or some sort of a setup which works between the principal, the shareholders, or directors and the agents, and then the third party which are carrying out those jobs. And those would basically show how the difference is clearly, say for example, recorded when we look at differentiating the roles and responsibilities of the principal or the shareholders, directors or the agents, and employees, staff, contractors, suppliers as the third party which are carrying out those tasks and activities to manage the various activities of the business or the organization. Now, the reason why we look at agency and the principles of agency specifically is that we need to understand that from a perspective of dealing with clients, we look at corporate governance. Now, the reason why boards sometimes are installed within companies, or when we also see, in some cases, the chief executive or the managing director actually is answerable to the board of the organization. Now, in those cases, the reason why this has been done is because in this case, the ownership of the organization, that means shareholders and the ownership of the organization, the investors as we call them, venture capitalists as you call them, they are separated from the organization itself to ensure that there is no conflict of interest. So if the owners and the shareholders of the organization and large public listed companies are the same, then it can lead to conflict of interest. And in those cases, it sets a bad example for governance of these organizations. So even if people who have founded the companies and in the company is doing quite well, they are managing or running the company or the organization as the managing director, as the chief executive, they would basically look at diluting their stock or their equity in the organization. In some cases, if they have to be rewarded or if they are given shares or, some sort of incentives are given, then that is all done under the, the pretext of corporate governance. And some part of this is covered under the Companies Act of 2006. So here, what we need to do is clearly understand, the principles of agency and how it can impact the business practice and this needs to be done primarily from the coverage of the principles of agency or agency theory, as we call them, and this is used to look at explaining how to mitigate and reduce any disputes, areas of conflict, interest of conflict which can happen when we see a relationship being formed between the principals and the agent and the people who are required to carry out some of these services. So the main principles of agency tend to be three: the agent, the principal, and the whole relationship which involves people, clients, parties, suppliers carrying out those responsibilities or actions on behalf of the principal to ensure that there are no conflicts of interest. Is that okay? Any questions on this so far? Now, one of the reasons why, if we do a quick recap and see why this has been introduced or why the principles of agency or theory of agency theory is important, is that if we go back in time and see the number of corporate scandals which have happened, number of companies which have collapsed because of financial misreporting, because of avoiding or let's say violation of legal terms and conditions which are required to produce financial statements, under-reporting of, say, over-reporting of profits, for example, claiming depreciation. We look at investments being done in different funds which are not actually returning the amount of returns which are actually shown on the assets or the balance sheets of the companies. This has led to a lot of companies and businesses collapsing globally. And in order to make sure that the interests of the owner or the major shareholders of the company do not create a conflict of interest in running the day-to-day activities of the business or the organization, the agency theory is now taking a lot of importance and is now something that we need to be aware of. That sometimes when you look at Companies House, you look at a couple of years back, this particular terminology called person of significant control, PSC, was introduced. Now, if you go back before 2010, this was not there. But every year when the annual statement for the companies are filed, normally the PSC has to be declared, or if there are changes to the person with significant control of shares, if there is a change in that, that has to be reported in the annual statement AR03 form, which is filled in normally by accountants or agencies which are managing or providing accountancy services. And the reason why this has been done is to ensure that person with significant control does not have direct bearings on the operations of the company, and this is part of it is covered under the agency relationship, and it is one of the best practices which the Companies Act of 2006 has brought in order to look at avoiding such conflicts of interest to happen, specifically related to corporate governance. Now, very quickly, if we look at the third assessment criteria, which is 1.3, and it talks about the law of tort and obviously remedies. So when we talk about the law of tort, essentially what does that mean? As I explained earlier, briefly at the start of the discussion on this unit, is the law of tort is basically the branch of law under the jurisdiction of, say, for example, the English legal system, which looks at civil wrong, which can actually occur because of negligence or because of, let's say, prevailing conditions which individuals would not want normally to happen, but it can result in some sort of a harm or some sort of, let's say, a loss or some sort of liability which can be created. And in those cases, what we will look at is a civil wrong being done or a breach of duty or a breach of contract happening. Then in those cases, those infringements, are covered as legal rights for the defendant or one of the party, and that tends to be covered under, the law of tort. And this basically allows either party, if they are being dealt the wrong hand, to basically look at claiming damages. Now, when we talk about, the law of tort, there generally tends to be two options. And these two options, when we talk about tort, we talk about tort essentially, which basically mean, is one side, and the other means, tort of negligence. So when I look at the word and the meaning of tort, I don't know if some of you have looked at the meaning of the word tort. Tort actually means wrongful act, or it means an infringement, right? So when we talk about a wrongful act, or when we talk about, say, for example, something which leads to creating a liability, we will cover that under what is called the Tortuous Act or the law of tort. So in this case, when we talk about in specifically in a person case basis, it would mean an assault has been done, a battery has been done, or damage to a personal property has been done, or you've done something without the consent of the other party, and that is going to create legal liability or damages in terms of financial costs for the other party. Now, in some cases, this can also mean, emotional distress. So sometimes when you look at personal injury claims, or people when they have injury and that injury is not bodily, but over a point in time, it also causes emotional distress, then those are also things which are covered under, tort law. Now, when we talk about tort of negligence, this means deceit. This means you're doing something wrong and it is being done on purpose. So when we talk about tort of negligence, this is under the law considered as legal wrong, and that is something that you've suffered because somebody's action has caused this particular end result to happen, and this could have been avoided if proper care, or for example proper let's say proper dereliction of these services or the duties would have been done. So in this case, if reasonable care is not taken to avoid the harm which can be done, then this is covered under tort of negligence. And because these two are generally quite opposite, so tort means wrongful act, and tort of negligence means if it could have been avoided if things were done right. So basically these two are quite important when we look at cause and effect in a way. So when we talk about cause and effect, or when we talk about if this was done as per the contract, things would have turned out fine. If the contract has not been delivered as per the terms and conditions defined, then that would mean that these damages, or for example loss, or anything which is basically led to not getting the right result, could have been avoided if negligence would have not happened. So these two tend to be looking at let's say the opposite side of things. And when we talk about these are important because they are legal wrongs. And when we deal with contracts, when we deal with situations in which you are representing a client, sometimes an example that I would normally put here in terms of practical context that we see, how do we look at invoking the law of tort or tort of negligence, is that sometimes when you, not sometimes, at the year end, for example, you drop the accounts for your client, but before you file the accounts, normally in the profession, what we do is we send the accounts off to the client to say that could you go through these accounts which have been done and sign them off, sign them off from a point that they are true and correct. They are okay for it to be, that's okay for you to go ahead and submit to Companies House and, various other places where it needs to be submitted. Now, when you get that signature of your client, what you're trying to do is that you have done your bit, but obviously it is the accounts for the company or your organization, and you need to check and sign it off that whatever information has been provided accurately, it is factual, and what is represented in the accounts are correct as per what you have provided to me. And that is where, if when you get that and then you file it and everything goes okay, but if an inquiry is to open up from HMRC, or if the VAT was not declared correctly, or for example, if the dividends was not declared correctly, and an inquiry is to open up into the accounts which have been submitted, which the companies and individuals have to keep for a period of 6 years, and within those 6 years, if it is to be opened up for an inquiry, then that signature that you have taken, or that approval that you've taken before it was submitted, saves you from any tort of negligence, because you have taken the approval before these were published, or these were submitted to Companies House or to HMRC. So in this case, the liability or the damages would sit with the client, because what you have prepared have been prepared on the basis of what information has been provided. So this particular law of tort, when we talk about explain the law of tort and remedies available, comes in handy because it helps you act on behalf of your client. But the main elements of it is that when you're acting on behalf of the client, you're ensuring that you're getting the sign off, and the information which is being provided, you have got a sign off, and these are represented accurately and factually as per when you prepare these accounts. But if it is to come to light that they were not provided accurately, and this was something which was an oversight or were overlooked, then in those cases they will be covered under the thought of negligence, saying that okay, this was overlooked. However, HMRC would say, okay, you can close this matter by paying a fine or a penalty, and in those cases, they can be used primarily to close some of the inquiries which essentially happen. So in this particular task, what you need to be able to do is theoretically explain what is law of tort and what are the remedies available. And I've talked about some of these remedies available. So elements of tort have been covered, and I've talked about some of the remedies which are available for you to be able to explain this using an example. Now, when you go on to the Moodle, and on the Moodle, when you see the particular, this particular learning outcome, what I've also done is I've put 2-3 specific cases which will help you understand, case history or cases which are, to understand how this is actually practically applied. And this is what you get to see on the slide here as well. So Donahue versus Stevenson, when this was tried in court, what was the outcome of that and why it was tried and how it was covered under the law of tort or tort of negligence is explained using an example. So this will help you cover, and understand how this is relevant and how this is important when we look at applying this in our day-to-day, obviously practical work life. Now, there is one part of the element in this, which is an assessment criteria related to merit, which talks about assessment of the validity of given contract. So again, here what we have to do is, it's not a new task. We've discussed the contract and the several elements of the contract. What we need to be able to do is take up an example and assess the validity of a given contract. So we have taken some examples, which is primarily Feldhaus versus Bindley, and this is one of the known cases which is published in the Law Gazette. And what we want to be able to do is find out if there was a contract and was it relevant and was it valid or not. So there are not going to be any right and wrong decisions on this, but yes, what we need to be able to do is the assessment side of things. We need to take up an example, and in this case, using that example, we have to explain whether the contract was valid or not. And in order to accomplish this task, I've taken up 2 examples. One is Feldhaus versus Bindley, and the other is Adams versus Linsell. So here, the facts of the case are presented, what was the judgment passed in the court of law, and whether this contract was valid or not valid has been then concluded towards the end. So in order to achieve the merit task, you will have to look at taking either of the examples. There are plenty of other examples that we also have, and the idea would be to assess the validity of a given contract. You can also pick other examples, and they could be examples that you have access to. For example, if you're a landlord, if you have a client contract and you feel that whether, and if there were, circumstances in which that went to court and you would want to anonymize some part of it and use that as an example to explain whether the contract was valid or not, can also be done. But essentially, to do the assessment here, you have to take an example by explaining what was the background, why was the, why did this land into the court of law, and what was the judgment provided in the court, whether it was held or whether the plaintiff or defendant, you have to explain that and then basically come to a conclusion that whether the contract was valid or not. How can we come to the conclusion whether the contract was valid or not? We look at the first 3 basic elements of agreement of offer and acceptance and consideration, and then expand it further to include things like privity, mitigation of risk, and then also remedies. And if they were included in that contract, then that would show the assessment and help you achieve the merit task. Now, there is one distinction criteria as well, which takes it a step higher in terms of, doing after the assessment. It talks about evaluation. And here the evaluation is to look into the implications of agency relationship for principal and the agent. And here, this is an extension to the task that we've done or discussed primarily, in 1.2. So when I look at the merit one, it is the assessment of the validity of given contract using these two examples. And when I talk about distinction, it is to look at the implications of the agency relationship, which is what we have covered in task 1.2. So here, the evaluation will happen by taking a specific example. So what I've done is, I've used an example of shareholders and auditors. Sometimes when you look at Companies House and large organizations, which have, say, we have micro businesses which have turnover less than 350K annually, less than 10 employees. You look at small businesses between 11 to 50 employees, turnover between 350K to 3.5 million. Then you look at small medium businesses or enterprises, 50 to 250 employees, turnover between 3.5 million to 6.5 million. And then you have large companies or businesses, public large businesses essentially, which are going to be upwards of 6.5 million and more than 250 employees. So I've taken up an example here to look at evaluation primarily, in an organization wherein there are shareholders, and when the accounts are published or filed with HMRC or with at the end of the year with, say, Companies House, the accounts also needs to be audited. So there is a requirement for certain organizations in the public sector, certain organizations on the financial services side, any such semi-government organization where the accounts have to be audited at the end of the year before they are filed, after they are filed. Then in those cases, we could use the example to look at the implications of agency relationship between the principal and the agent. So some of us work as accountants, but we are not on the register of auditors. And in some cases, if a client is to seek services from us that can you get my accounts audited? So what we will need to do is basically we become the agent. The client who has asked for the accounts to be audited becomes the principal, and the agency or the registered auditor that you use maybe in your circle, or you get those services from an auditor which is registered to audit the accounts for the client, would provide the agency relationship. So here, using an example, some part of it would be to look at why this process is required and how the audit is getting done. So in those cases, using that example, you'd be able to cover this particular criteria, which talks about the one is explaining how this process works, but the second part would be the implications that we have to cover in terms of, when the audit is done and, the auditors sign it off and then it is published. So what could be the implications in those circumstances is what we need to understand by, explaining that in a bit more detail. And that would basically look at, covering the evaluation side of things. So this task, generally is an extension to what we have covered primarily as explain, if you see, principles. So here we had theoretically and descriptively just covered the agency theory or the principle of agency. But in this task 1D1, what we are looking at doing is by an example showing the application of how the agency relationship works. And in this case, I've taken up a scenario of shareholders and the auditors, or maybe a company getting the accounts audited through the accounting firm, wherein the accounting firm becomes the agent. The principal is the, the organization which is asking you to get the accounts audited, and the route that you take to get it done through an auditor, which is on the register of auditors, and the whole process forms the agency relationship. So what we are looking at doing is talking about some of the implications which could happen if this particular audit does not go right, or in this case, the audit does not come out correct from what the accounts have been prepared. What could be the implications of that? And that is what you need to be able to cover, keeping in mind, some of the law and legislation related to the, the UK Corporate Governance Code of 2010. You talk about the, the Companies Act of 2006, and using an example, cover that in order to complete this task. So any questions on this so far? Any questions on this? If I go, so this also helps us complete learning outcome 1. So from our point of view, we've covered this comprehensively in a bit more detail today, and that would hopefully give you insight and knowledge into understanding the elements of law which affect some of the commercial practices. So I'd like to take any questions at this stage.
No, there is no question. Most probably everything is cleared. Only there was one word, quasi contracts. That was quasi or something. I'm not sure about that. What was that? And that's it.
So when you look at the meaning of the word, what does quasi mean? So when I talk about different types of contract, there are unilateral, bilateral contracts. There are something also called quasi-lateral contracts. So apparently sometimes when you think that the contract is formed, but in reality the contract is actually not there. So you decided to take up a property on rent. You were discussing with the lettings agent, you showed an interest, you put an offer down, but the offer wasn't accepted, but you are under the impression that the offer has been accepted, and you would be looking at moving into that property. So that would be basically an understanding that apparently it wasn't there or it hasn't yet formed, but you seemingly believe that a contract has been formed. So a quasi-contract is basically sometimes from a law perspective, when we look at not literally the meaning of quasi, but when we look at from a law perspective, what we are looking at doing is basically trying to understand that if a active agreement or an arrangement can happen, between two parties, then in those cases, those kind of contracts would generally be called, let's say quasi-contract. An example of that I would give you would be that, for example, from a point of view of assuming that there's a contract which is formed, what will happen is, say, if you are party A and I'm party B, what will happen is that I believe that I have placed an order with you for delivering such goods, but in return you accidentally end up delivering that goods to somebody else. So a practical example of this sometimes happens is that you've ordered something on Amazon. Now Amazon and you have a contract. When you order something through the app, they debit your card, or when you buy something on Amazon, you are liable to pay for those costs, and you believe that the product is being delivered, but after a certain point in time you find out that the product has been delivered by Amazon, but it has not got delivered to you. So in this case, what has happened is the product is accidentally got delivered to somebody else, or when you are not at home, it's got delivered to somebody else, but Amazon thinks the contract has been fulfilled. You feel that the contract has not been fulfilled because I haven't received the goods. So in those cases, you would generally see that the agreement or the contract which has been executed in intention is to agree and have that delivered, but actually has not happened in the actual sense. So when we talk about this as an example, what you would generally see is that by accident, if the goods have been delivered to somebody else and they have not delivered it to you, you would normally feel that the contract has not been fulfilled. So in those cases, what we will say is that the contract apparently, according to Amazon, has been fulfilled, but in reality, it is not, because you haven't got the goods. So those kind of contracts, when they are taken to court, it is very important on both parties to ascertain the terms and conditions which were set out originally in terms of the contracts were exchanged. And in some cases, when some of these do not turn out to be the way they were intended to, we will call them as quasi-contract. Is that okay? Is that clear?
Yes, 100%. Thank you very much. Thank you. Yeah.
Good stuff. Let me just go across to Aid. Are you any questions at your end on today's session?
No, I think I'm all right. Thank you.
Good stuff. Udesh, any comments at your end? Any questions at your end? Right, okay. I think he's muted, but that is where I'll probably end today's session. And obviously a copy of this particular recording, yeah, he's texted me 1 second, just checking. All good. Okay, thanks for that. So what I'm going to do is stop the recording.